In the second video devoted to consolidation workings, we turn our attention to non-controlling interest, a concept which becomes relevant when the parent entity does not own the entire share capital of the subsidiaries over which it exercises control. Just as before, we will illustrate the concept and its impact on consolidated financial statements by means of an example, which, to the extent possible, utilizes the same figures as the initial example from the previous module. Let us again assume that P made an investment in S, but this time acquiring just 80% of the share capital of S for €6,400 when the statements of financial position of the two entities were as follows. You should appreciate that despite owning less than 100% of S's share capital, P still exercises control over the subsidiary and is therefore required to prepare a consolidated statement of financial position, in which its assets and liabilities are going to be combined with those of S. Let us begin by drawing the cost of control T account, which will allow us to compute the amount of goodwill, if any, recognized in respect of the transaction. You should appreciate that when dealing with transactions where less than 100% of the share capital is acquired, goodwill may in fact be computed using one of two approaches. The proportion of net assets method, which we will illustrate first, and the fair value method, which we will show second. Under the proportion of net assets approach, the amount of goodwill recognized reflects the portion that is attributable to the parent entity only. Utilizing the cost of control account, this is achieved by transferring to its debit side the 6,400 of investment in S, and subsequently recording on the credit side of the account just 80% of the share capital and retained earnings of the subsidiary as at the date of acquisition, where 80% naturally corresponds to the portion of S's share capital that is owned by P. Accordingly, share capital is adjusted downwards by 80% of 3,000 or 2,400, whereas retained earnings are reduced by 80% of 2,000 or 1,600, with both amounts being simultaneously recorded on the credit side of the cost of control account. You should appreciate that the account now holds the price paid by P to acquire 80% of S's share capital and P's share of the value of S's net assets at the date of acquisition. The debit balance of 2,400 is, just like before, referred to as goodwill and is recognized in the consolidated statement of financial position as an intangible asset. The remaining 20% of S's share capital and retained earnings as at the date of acquisition, so that 600 and 400 euro respectively, are transferred to a separate line within the consolidated equity section known as non-controlling interest. We are now in a position to compute the consolidated totals for all of the statement of financial position line items, starting with goodwill of 2,400 and other assets of 17,600, which when added produce a total of 20,000 euro. Consolidated equity comprises the share capital and retained earnings of the parent entity plus that non-controlling interest balance of 1,000, producing an equity total of 16,000 euro. Consolidated liabilities are the sum of 2,500 and 1,500, giving 4,000. When we total the consolidated equity and liabilities balances, we get a total of 20,000, which naturally equals the previously computed asset total. It is important to note that consolidating a less than wholly owned subsidiary still requires that the subsidiary's assets and liabilities be added to similar items of the parent in their entirety, that is, without making any attempts to consolidate only that portion of their value which is attributable to the parent. As a consequence of reporting 100% of the subsidiary's net assets, the portion that is not owned by the parent is apportioned to the non-controlling shareholders in a separate line within the equity section of the consolidated statement of financial position. The second method of computing goodwill, that is the fair value method, involves recognizing the amount of goodwill attributable to the group as a whole. Let us now assume that in the previously analyzed example, the fair value of the 20% non-controlling interest is deemed to equal 1,600. If that is the case, the cost of control account will receive a debit of 6,400, the result of eliminating the investment in S. It will also be debited with the fair value of the non-controlling interest, which we assumed to equal €1,600, with the corresponding credit going to the non-controlling interest line in the consolidated statement of financial position. Finally, the subsidiary's share capital and retained earnings as at the date of acquisition are removed and transferred to the credit side of the cost of control account. This naturally produces a debit balance of 3,000, which is reported in the consolidated statement of financial position under the heading Goodwill. The remaining line items are summed to produce other assets of €17,600, total assets of 20,600, share capital of 9,000, retained earnings of 6,000, non-controlling interest of 1,600, an equity total of 16,600, and liabilities of 4,000, with the equity and liabilities total coming in at 20,600. As you can see, the choice of goodwill measurement method has obvious consequences for the figures reported in the consolidated statement of financial position. IFRS 3 allows for this choice to be made for each business combination on a transaction-by-transaction basis, rather than as an accounting policy choice. To finish this module off, let us further note that any profits made by a subsidiary following its acquisition will have to be apportioned between the retained earnings of the group and non-controlling interest.